Welcome to Unit 6, Adjustment to Final Account. We remembered from the stages of the accounting process that after the financial statement have been prepared, there could be issues or events occurring after the financial statement date, which may require adjustment to the financial statement. Among these are prepayment and accruals, bad debts, depreciation, among others. By the end of this session, you should be able to describe the methods under depreciation, compute annual depreciation charge using the straight line method, and compute annual depreciation charge using the reducing balance method. Methods of calculating depreciation charge for the year. The amount of depreciation can be determined when we sell a fixed or a non-current asset, but we cannot simply wait until the date of sale to account for depreciation. Otherwise, we would not be obeying the matching concept, and as a result, we would be overstating the profit achieved over the life of the asset. The year in which the sale takes place would also bear the full reduction value. The matching concept requires the depreciation cost to be charged to the accounting periods which benefit from the use of the asset. That is, if the motor van is expected to last for 3 years, then the depreciation should be spread over the 3 years as each year will benefit from its use and should therefore share in the cost and just year 3 when the van is scrapped or sold. There are a number of methods which are used in determining annual depreciation charge. Some of the methods include the straight line method, the sum of the years they get method, reducing balance method, depletion method, revaluation method, sinking fund method, and annuity method. Let's look at the straight line method. The straight line method, also known as fixed installment method, charges an equal amount of depreciation in each year of the asset's life. It assumes that the fixed asset is equally beneficial during each year of its useful life. Therefore, the same amount of depreciation is charged as an expense for each year. The annual depreciation charge is calculated as follows. The original cost minus the estimated salvage value over the estimated useful life. The original cost is the cost at which the asset was acquired. The estimated salvage value or the scrap value is what the asset could be sold for at the end of its useful life. And the estimated useful life is the anticipated life of the assets to be used in the business. Let's look at this illustration. The original cost of a motor van bought on 1st January 2008 is $22,000. The estimated salvage value is $2,000 and the estimated useful life is 3 years. We have to calculate the annual depreciation. Using the formula, original cost minus estimated salvage value over estimated useful life, the original cost is $22,000 minus the salvage value, which is $2,000 over the useful life, will give us 6,667.67 pesos. The year by year position of this motor van is shown as follows. So year 1, the original cost as will stand in the statement of financial position is 22,000. The depreciation for the year as we computed is 6,666.67. Then the accumulated depreciation for the first year will still be the depreciation for the year. Then the net book value. The net book value is computed as the cost or the original cost minus the accumulated depreciation. That is what will give us the net book value. So for year 1, the net book value will be 22,000 minus the depreciation, 6,667.67. And so we have 21,333.33. In year 2, again, we'll have the cost of the asset as 22,000. Because we are using the straight line method of depreciation, the depreciation charge for each year will be the same. So for year 2, the depreciation will be 6,666.67. Now the accumulated depreciation for year 2 will be the depreciation for year 1 plus the depreciation for year 2. So it will be 6,666.67 plus year 1's depreciation of 6,666.67, giving us 13,333.34. Now the net book value for year 2 will be the cost of the asset minus the accumulated depreciation. So the 22,000 minus 13,333.34 will give us 8,666.66. In year 3, the cost of the asset is 22,000. Because we are using the straight line method of depreciation, the depreciation charge for year 3 will also be the same, 6,666.67. So the accumulated depreciation will be the sum of the depreciation for year 1, year 2, and year 3. And that is 20,001. Now, if we deduct this accumulated depreciation from the original cost, we arrive at the net book value. So we see that the net book value is approximately 2,000. So if we deduct the scrap value, then the asset will be out of our books. So that is the net book value. Now we are going to show in the statement of profit or loss the depreciation charge for each year. So the depreciation charge for each year will be treated as an expense in the statement of profit or loss. And we remember the matching concept. That means the benefit from the use of the asset is matched against the cost of the use of the asset. So the depreciation charge for each year will be the cost for the use of the assets. So we deduct the depreciation as an expense in the statement of profit or loss. In the statement of financial position, we will show the original cost, which is 22,000, less the accumulated depreciation, and then the net book value. So these are the three figures that will display in the statement of financial position. So that by the third year, we'll have the net book value as 1,999.99. The reducing balance method. This method of depreciation assumes that the efficiency of the non-current asset decreases year by year, so the annual depreciation charge is decreased accordingly. The depreciation written off in each year is fixed percentage, not of the cost, but of the book value, the written down value at the beginning of the year. The percentage rate of the depreciation to be charged is calculated using the formula, where using the formula rate of depreciation equals to 1 minus the root of the number of estimated useful life, then the estimated salvage value divided by the cost of the assets times 100. Let's look at this illustration. If a motor vehicle costing 22,000 is depreciated at 28% per annum on reducing balance, for year 1, the depreciation charge will be 22,000 times 28%, giving us 6,160. Year 2, in computing the depreciation charge for year 2, we'll have to estimate the net book value, which is the cost of the asset minus the accumulated depreciation. So the cost of the asset is 22,000 minus the accumulated depreciation 6,160. So we'll arrive at the net book value of 15,840. That is why it is called reducing balance. So this for year 2, the 15,840 is multiplied by the rate of depreciation, and that is giving us 4,435.2. Again, we estimate for the accumulated depreciation by deducting the net book value by deducting the accumulated depreciation, and then for year 3, the net book value will be 11,404.8. We multiply that by the rate of depreciation, and the depreciation charge is 3,193.34. For year 4, we estimate again the net book value and multiply that by the rate of depreciation, 28%, and we arrive at the depreciation charge for that year. So the depreciation charge for a specific year is debited to the profit or loss account. It's expense, so it's going to be deducted from the profit or loss account, or as the merchant concept, to reduce the benefit that accruing to the business from the use of the asset. So in the year 1, 6,160 will be debited to the profit or loss account. In year 2, 4,435.2 will be debited to the profit or loss account. In year 3, 3,193.34 will be debited to the profit or loss account. And in year 4, 2,299.21 will be debited to the profit or loss account. But in the statement of financial position, we only show the original cost, the accumulated depreciation, and the net book value. So for year 1, the statement of financial position will indicate for motor van the cost 22,000 minus, or the accumulated depreciation 6,160. So when we less that, we arrive at the net book value of 15,840. Again, the statement of financial position for year 2 will indicate the original cost 22,000 less the accumulated depreciation 10,595.2, and then we have the net book value. So in that order, that is how we show the depreciation charge in the statement of profit or loss and in the statement of financial position. In this session, we described the methods under depreciation, and we also computed the annual depreciation charge using the straight line method and computed the annual depreciation charge using the reducing balance method. Thank you.